In our journey to understand investing, we've talked about the basic building blocks, stocks, bonds, and how professionals can manage them for you in funds. Today, let's explore a crucial choice every investor faces: convenience versus cost. Specifically, we're going to compare two of the most common ways to buy a diversified portfolio: mutual funds and their popular lower-cost sibling, exchange-traded funds, or ETFs. Let's start with mutual funds, as they're often the first professional management tool people encounter. A mutual fund pools money from thousands of investors. A professional portfolio manager and their team use that pool to buy a large collection of stocks, bonds, or other assets. When you buy a share of the mutual fund, you own a tiny piece of that entire collection. It's instant diversification and professional management in one package. This service, of course, comes with a cost. There are salaries for the managers and analysts who pick the investments. There are trading fees for buying and selling within the fund. There are administrative costs for record keeping and customer service. Often, there's also a fee paid to the financial advisor or representative who sells you the fund. All these costs are bundled into what's called the fund's expense ratio, which is a yearly fee expressed as a percentage of your investment. For many investors, these fees are worth it. They value the professional selection, the automatic rebalancing, and the guidance from an advisor. It's a full-service, hands-off solution. But other investors start to ask a question: what if I just want the investment product itself at the lowest possible cost? This desire has fueled the enormous rise of a powerful alternative, an exchange-traded fund, or ETF. An ETF is, at its core, very similar to a mutual fund. It also pools investor money to own a basket of securities. However, the way you buy and sell them and their inherent cost structure are fundamentally different. To understand ETFs, we first need to understand what an exchange is. An exchange is simply a marketplace where investors trade securities with each other. The New York Stock Exchange is a famous example. You don't buy from the exchange itself, you buy from another investor who is selling. This is the key difference. You buy a mutual fund directly from the investment company that manages it or through an advisor. You sell it back to them. But you buy and sell an ETF on a stock exchange just like you would an individual stock. You're buying shares from another investor on the open market, not from the ETF company directly. This simple change in the trading mechanism unlocks significant cost savings. Because ETFs trade on an exchange, the fund company doesn't need to maintain a large sales force or handle individual buy and sell orders from millions of customers every day. This eliminates a major layer of cost. These savings are passed on to you, the investor, through a much lower expense ratio. It's common for an ETF to cost less than a tenth of what a similar mutual fund charges. There's a second major reason many ETFs are low cost: their investment strategy. A huge category of ETFs are index funds. Instead of paying a team of analysts to actively pick which stocks will win, an index ETF simply aims to mirror the performance of a specific market index. An index is just a predefined list of securities that represents a segment of the market. The S&P 500 index, for example, is a list of 500 of the largest U.S. companies. An S&P 500 ETF buys all or a representative sample of the stocks in that index. The goal isn't to beat the market, it's to match it. This passive strategy requires far less research and trading than an active strategy that tries to pick winners, which again leads to lower fees. The philosophy here is that over the long term, it's very hard for active managers to consistently beat the market after their high fees are deducted. So, a low-cost index tracker is an efficient way to capture market returns. Now, it's important to know that not all ETFs are passive index funds. There are actively managed ETFs as well, which come with higher fees. But the core appeal of the ETF structure for most beginners is its ability to deliver simple, broad diversification at an exceptionally low cost. You can find ETFs for virtually every part of the market: total U.S. stocks, international bonds, specific sectors like technology, and more. So, with all these benefits, are there any trade-offs with ETFs? Yes, a few. First is pricing. A mutual fund's price, called its net asset value, or NAV, is calculated once at the end of each trading day. Everyone who buys or sells that day gets the same price. An ETF's price fluctuates throughout the trading day based on supply and demand, just like a stock. While it typically stays very close to the value of its underlying assets, this can add a tiny layer of complexity and potential for a small price discrepancy. The second and more significant trade-off is guidance. When you work with an advisor to buy a mutual fund, they help you choose one that fits your risk tolerance and goals. When you buy ETFs on your own, you are self-directing. You must choose which ETFs to buy and in what proportions. This requires a bit more knowledge and confidence. For a complete beginner, this analysis paralysis can be a real hurdle. This very challenge has led to the creation of another modern tool, the robo-advisor. A robo-advisor isn't a physical robot. It's an online platform that uses algorithms to provide investment management. You answer a questionnaire about your goals, time horizon, and risk tolerance. The software then automatically builds and manages a diversified portfolio for you, typically using low-cost ETFs. The robo-advisor handles all the asset allocation, rebalancing, and reinvestment. For this service, it charges a small fee on top of the ETF fees, but the total cost is usually still far lower than using a human advisor and traditional mutual funds. It's a perfect middle ground for someone who wants a hands-off, professionally constructed portfolio, but is very cost-conscious. It provides a system without the sales pressure. Let's summarize the landscape as it stands for a new investor. You have a spectrum of choices. On one end, you have full-service, advisor-sold mutual funds. They offer maximum convenience and guidance, but come with the highest costs. On the other end, you have self-directed ETF investing. It offers the lowest costs, but requires you to make all the portfolio decisions yourself. In the middle, you have robo-advisors. They offer a blend: automated professional portfolio construction using low-cost ETFs for a modest additional fee. It's a powerful and accessible starting point for the digital age. For many beginners, a robo-advisor is the ideal entry into investing. It's simple, low cost, and removes the emotional difficulty of making individual investment choices. Your choice depends on what you value most. If you deeply value a personal relationship and ongoing financial advice and are willing to pay for it, a human advisor with mutual funds may be your path. If your top priority is minimizing costs and you enjoy learning and taking control, self-directed ETF investing could be rewarding. If you want a smart, automated, low-cost system that does the work for you, a robo-advisor is an excellent modern solution. The most important step is to start. Whichever path you choose, you are moving forward with a structured, diversified approach, which is far better than letting money sit idle or making impulsive stock picks. Understanding these options empowers you to make an informed choice that fits your personality and your financial goals. The world of investing has evolved to offer efficient solutions for every type of investor. The trend is clear. Costs matter enormously over decades of compounding. Even a 1% difference in fees can add up to hundreds of thousands of dollars over an investing lifetime. Being mindful of fees doesn't mean being cheap, it means being efficient. It means ensuring more of your money stays invested and works for you, rather than paying for unnecessary complexity. For Invest Easy 101, our goal is to point you towards simple, effective strategies. For most beginners, starting with a diversified, low-cost index ETF, either on your own or through a robo-advisor, is a profoundly solid foundation. It captures the growth of the global economy in a single, understandable package. It's the bedrock upon which you can build as your knowledge and wealth grow.
Thank you for learning with us today. If this comparison between mutual funds, ETFs, and robo-advisors helped clarify your options, please consider subscribing. We're here to demystify investing and help you find your confident first step. Let us know in the comments which of these investment vehicles you're most interested in learning more about.